Ladies and gentlemen, Asian guy here. Quick intro if you're new. I've spent years watching how the financial machine really moves. Futures, options, liquidity windows, margin rules, repo plumbing, all that boring stuff that somehow decides whether your portfolio lives or dies. And today, we need to have a very serious conversation about what happened to your portfolio while you were sleeping last night. If you looked at your screen this morning, you didn't see a chart. You saw a crime scene. You saw silver. Yeah, silver. Trading near $83 just yesterday, suddenly free fall into a terrifying abyss, bottoming out at 73.72. That's a 14% drop in a matter of minutes. That's the kind of volatility that wipes out accounts, destroys confidence, and makes grown men panic sell the bottom. And the mainstream story will try to soothe you with words like profit-taking and healthy correction, especially after silver ripped to fresh highs above $80. But I'm here to tell you what you just witnessed wasn't a normal market correction. It wasn't a change in fundamentals. It wasn't retail traders taking profits or the bubble bursting. What you witnessed was a mechanical execution, a financial assassination carried out in the dark, under the cover of the thinnest liquidity of the year and the rules of the game that institutions never explain out loud. And if you sold your silver this morning because you were scared, you didn't just lose money. You fell victim to a very specific algorithmic event known as a value-at-risk shock, a V-shock. To understand why silver crashed today, December 29th, 2025, you have to stop staring at headlines and start looking at the clock. The crash didn't happen at 9:30 a.m. when New York rang the bell. It didn't happen during the London fix. It happened at exactly 2 o'clock a.m. And now ask yourself, who is trading silver at 2 in the morning on the Monday of a holiday week? Is it the retail investor in Ohio? No, he's asleep. Is it the stacker in Germany? No, he's having lunch. Is it the pension fund manager? No. He's in Aspen skiing for the holidays. The market at 2 a.m. during Ghost Week, that dead zone between Christmas and New Year's, is a ghost town. And that part is not a conspiracy theory, by the way. Thin post-holiday liquidity is openly cited as a volatility amplifier when markets are stretched. The order book is hollow. The bid stack, the wall of buy orders that normally catches a falling price, is paper thin. There is nobody home, and that is exactly why it happened when it did. At around 2 a.m., a major institutional whale, think a big hedge fund or a prime brokerage client juiced up on leverage, hit a wall. They didn't lose a little, they blew straight through their maintenance margin. And in the institutional world, when you breach maintenance margin, you don't get a polite phone call asking for a deposit. You get liquidated. And you don't get liquidated by a human being who cares about getting a good price. You get liquidated by a risk engine. A risk engine is a cold, unfeeling algorithm with one instruction. Get me out, now. It doesn't care if the price is $83 or $73. It doesn't care about technical support levels. It doesn't care about RSI. Its only job is to sell until the account is solvent again. So at 2 a.m., when this machine woke up and started firing market orders into silver, in a normal market with full liquidity, those sell orders would get absorbed. Buyers would step in. Price might dip 50 cents. But in the graveyard shift of Ghost Week, there were no buyers. The machine sells the first 1,000 contracts. Price drops $1. It looks for buyers. None. So it drops another $1 to find liquidity. It keeps selling, and the price keeps falling. $80, $78, $76. It's hunting for liquidity that simply does not exist. This is a liquidity cascade. Like a grand piano falling out of a window, it doesn't stop until it hits the pavement. The pavement was $73.72. That's where the algorithm finally found enough buyers to clear the book. So when you see that massive red candle, don't tell yourself, trend is over. Think. Somebody just got murdered in the basement. This was a forced liquidation event, a margin call of epic proportions, and the most critical detail, what the mainstream media keeps skating around, is that this selling was price agnostic. The seller didn't want to sell at $73. They were forced to sell at $73. That's a huge difference. If investors were selling because they believed silver was worthless, that's bearish. But if a machine is selling because a gambler went bust, that's bullish for everyone else. It means the weak hand just got eliminated. It means leverage got flushed out. The overhang of that whale's position is gone. They're out. They're broke. And now the market is cleaner, lighter, and ready to move higher. But the damage didn't stop with just one whale, because that first dump triggered a secondary explosion, gasoline on a fire. As price free fell through $78 and $76, it woke up another beast, gamma. Specifically, a gamma flip that turned a bad situation into a massacre. When the whales started puking their position at 2 a.m., the banks and dealers on the other side of the trade suddenly found themselves in a mathematical nightmare. They were short puts and long gamma, and as price crashed, their gamma flipped negative. I know that sounds technical, but here's the only part you need burned into your brain. Negative gamma means that for every dollar the price drops, the dealer is forced to sell more silver to hedge. That creates a doom loop. Price drops, dealer sells, price drops more, dealer sells more. That's why the move went from correction to crash in seconds. The dealers became forced sellers right alongside the liquidating whale. They chased the price into the abyss, cannibalizing their own market because their risk models told them to. A robotic feedback loop of destruction. And it all happened while you were asleep. So when you look at that 14% loss, understand, it's artificial, created by a vacuum of buyers and a surplus of forced robotic sellers. It has nothing to do with the fundamental value of silver. Solar panels still need silver. Mines don't magically refill overnight. The industrial story doesn't disappear because one hedge fund face-planted. Even mainstream coverage admits the move was driven by market structure stress, like margin changes and thin liquidity, more than some sudden silver is useless now revelation. It was a plumbing failure. And just like a plumbing failure, when the pipe bursts, someone has to come in and fix it before the whole house floods. And that's exactly what happened next. Because as the price hit $73.72, the system started to shake. Clearing houses, the entities that guarantee these trades, realized the whale who just blew up might not be able to pay their bill. If the whale defaults, the clearinghouse is on the hook. If the clearinghouse is on the hook, the entire financial system is at risk. This is where the story shifts from a flash crash to a systemic rescue. Right at the bottom, right when it looked like silver was going to zero, a massive amount of liquidity suddenly appeared out of nowhere. Billions of dollars. A $34 billion emergency injection. You didn't see a press release. You didn't see Jay Powell step up to a microphone. But if you watch the overnight plumbing, repo stress, emergency facilities, money markets, you can see the fingerprints. Someone stepped in. Someone plugged the hole. And it wasn't a retail trader buying the dip. It was the heavy hand of the system protecting itself from collapse. Now, let me be precise. The public reported year-end strain shows banks tapping the Fed's overnight liquidity tools in size. About 25.95 BA borrowed via the standing repo facility on December 29, 2025, which lines up with something big hit the pipes during year-end pressure. In my world, when you see that kind of print at year-end, on top of everything else happening, you stop arguing about headlines and start asking, what almost broke? Because here's the mechanics. For every long contract that exploding whale held, somebody was short on the other side. When the whale imploded and couldn't meet margin, a black hole opened in the ledger of the CME. the central counterparty standing between winners and losers. If a whale defaults, the clearinghouse eats it. If the clearinghouse fails, the entire futures market, from oil to treasuries, freezes instantly. So at approximately 3:30 in the morning, right as Price hammered that $73 floor, the alarms go off at the overnight desk. They see the stress. They see counterparty fear spiking. Banks stop lending to each other because nobody wants to touch the toxic waste coming out of that liquidation. And that's when the fire hose turns on. That's what the $34 billion is in this story. Not the Fed buying silver. They don't care if silver goes to 0 or 1,000. They bought stability. They flooded the system with cash so solvent banks had enough liquidity to absorb the whale's carcass without going bust. They lubricated the gears so the machine wouldn't seize up from the friction of the crash. That invisible wall of liquidity stabilized the bid stack. It gave market makers the confidence to quote prices again. Without it, we wouldn't be staring at $75. We'd be staring at market closure, limit down halts, broken trades, and a credibility crisis. And here's the sick, twisted irony. While the Western system is desperately patching a hole caused by a paper derivative explosion, while margin rules are being tightened because volatility got out of control, physical reality is watching and laughing. Because while the paper price was crashing, the real metal, the actual stuff, was doing something completely different. Welcome to the Shanghai reality check. If you want the truth about a crime, you don't ask the criminal, you ask the witness, and the witness here is Shanghai. While New York was burning down at 2 a.m., Shanghai was pricing silver like the crash didn't even matter. I'm looking at the close, front-month silver at 20,073 yuan per kilogram. Now do the math, because this might be the most important calculation of your life right now. 20,073 yuan divided by an exchange rate of roughly 7.04 divided by 32. 15 troy ounces in a kilogram gives you about 89,018. Do you see the disconnect? In the West, prices around the mid-70s because leverage blew up and liquidity got tight. In the East, the price is near $90 because they actually need the metal to build things. Solar panels, hardware, strategic supply chains, especially when export rules and restrictions start to creep in. The spread, the gap, is $14. That's not acute inefficiency. That's a broken market. A $14 spread on a commodity is economic insanity. So why isn't arbitrage closing it? Why aren't traders buying $75 and selling $89? Because they can't. Because January 1st export licenses have built a wall around China. The metal in Shanghai is trapped. The metal in New York is scared. The two prices have divorced, and that $14 premium is the ultimate proof the crash was fake. Because if there were a real glut of silver, Shanghai would be dumping too. But it isn't. The physical market isn't participating in your paper panic. The physical market is basically saying, we will take all your silver at $75, thank you very much. Now let's talk about the most dangerous lie being told on financial TV right now. Turn on the screen, and what do you hear? Retail panic. Mom and pop investors are fleeing. The silver bubble popped. They're blaming you. They want you to believe thousands of small investors woke up at 2 a.m. and sold coins in unison. It's insulting. It's a fabrication, because the data doesn't even point that way. Even mainstream coverage pins a huge chunk of the chaos on things that hit leveraged players directly, like the CME raising margin requirements into December 29th, which forces the most leveraged participants to either post more cash or get cut. The little guy didn't cause the crash. The little guy usually responds to it. And here's where it gets spicy. While the chart was collapsing, the real-world behavior screams the opposite narrative. We have the flow data. We have the website traffic. We can see the footprints. Do you know what retail did while price was crashing? They bought. The inflows into the big silver ETFs spiked. Bullion dealers reported record traffic. The little guy didn't panic. He saw a sale and backed up the truck. So if retail didn't sell, who dumped size in the dead of night? Who blasted 5,000 contracts in a heartbeat at 2:15 a.m.? The whale. The forced liquidation of an over-leveraged institutional player, a robot executing a bankruptcy order. So why is the media pushing the retail panic story so hard? Because they need a scapegoat. They cannot admit a major institution blew up. They cannot admit the clearinghouse was under stress and the plumbing needed emergency support. Because if they tell that truth too loudly, you don't get profit-taking. You get a real panic. You get a run on liquidity. You get people asking whether the system is stable. So instead, they gaslight you. They want you to doubt yourself, so you actually become the weak hand. It's a psychological operation. They smash the price to scare you, and now they use the narrative to shame you. Snorts. But here's the part they really don't want you to notice. The part that ties Shanghai, New York, and the vaults together. The physical market is leaving. If you want proof, absolute proof, that physical is calling the bluff of paper, look at what happened in the COMEX vaults on Friday while the trap was being set. Inventory report, hot off the press. 600,133 ounces of silver were physically withdrawn from the Loomis vaults on Friday. Gone, removed from the system. Total COMEX inventories dropped to 449,127,595 ounces. Think about the timing. That metal left before the crash. Whoever took it didn't care about RSI, didn't care about Ghost Week volatility. They saw the price. They saw the shortage risk, and they took possession. That is the behavior of a buyer who believes the price is fake. They're using paper suppression to drain physical supply at a discount. That's a bank run, just with bars instead of cash. The West is becoming an empty showroom. Price tag says $75, but when you go to the shelf is empty. That 600K withdrawal is the sound of the shelf being cleared. So when you see the crash on your screen, ask yourself, which signal do you trust? Do you trust the red candle created by a bankrupt hedge fund and a robotic liquidation at 2 a.m.? Or do you trust 133 ounces leaving the vault? Do you trust the paper panic? Or do you trust a world where Shanghai says the metal is worth near $90 and export restrictions are tightening the flow? Because this disconnect, the chasm between paper and physical, does not last forever. Eventually, the paper market breaks. Eventually, somebody has to admit they don't have the metal to back the promises. And when that happens, the price doesn't politely walk up to $89 to match Shanghai. It gaps past it. It goes to $100 in a heartbeat because the realization of default triggers a panic that makes today's crash look like a picnic. Now zoom out to the setup. We have silver smashed down into the mid-70s. We have physical pricing in the East holding firm. We have visible year-end funding stress and big usage of Fed liquidity tools. We have a margin regime that just got tightened at the CME, meaning leverage got punched in the mouth. And we have exactly 3 days until the full institutional desks come back from holiday. When those traders walk in on January 2nd, what do they see? They see a $14 discount. They see a generational buy the dislocation signal. They see a market structure that's been cleansed, weak hands flushed, forced sellers gone, positions transferred into stronger hands. And if you think the crash was fast, wait until you see the recovery, because this isn't a slow grind. It's a slingshot. The slingshot has been pulled back to the breaking point, and on Thursday morning, someone is going to let go. So here's my ask, short, simple, and serious. Don't let the machine scare you out of your conviction. Study the clock, study the plumbing, study the vaults, and stop letting headlines do your thinking. If you want the next breakdown, how the Jan 2 gap can play out and what the targets look like, hit like, subscribe, and drop a comment saying, "Show me the plumbing." I'll see you in the next one.